Hey everybody, Mike Lawson here with CU Broadcast. Welcome to our very first Mortgage Monthly show put on by the fine folks at CU Members Mortgage. And we're going to be diving into mortgage issues, events, and trends that are taking place throughout the industry each month. And we're going to have a subject matter expert coming on and talking about what they know best and how to help you guys out in your mortgage endeavors. And in this first episode, we have Mr. Steve Hewins from CU Members Mortgage talking about we're doing a little look back at 2020 and then how it will impact 2021. And Steve gets out his crystal ball and tells us what might be happening in 2021 as well. So check it out. Hey everybody, Mike Lawson here with CU Broadcast. Welcome to our show. And I must say, this is a new show. They're kicking off this is the inaugural Mortgage Monthly brought to you by the fine folks of CU Members Mortgage. And on the show today is Mr. Steve Hewins, one of our favorite recurring guests. Steve, how are you, sir?
I'm great. Excited about the new year and about what's ahead of us.
Indeed. And one of the big stories of 2020, other than the obvious, but if we're looking at business-wise and what you guys do, you're experts in, was housing. I think everybody is still kind of like, jaw is still on the ground of how well housing performed in 2020. Because I think initially people were like, oh my gosh, the sky's going to fall, everything's going to drop, out of the bucket and stuff like that. But it was quite the contrary, it sounded like. So what can you explain this? What happened?
It is funny. The year that we had for us to continue to find success in it. And I make a joke with my family. I said, leave it to the mortgage industry to find success in the middle of a global pandemic. And we really did. And I think it was really about monetary policy being friendly. Rates really stayed very low. With rates low, that helped with the affordability of housing. The Fed continued to provide assurances that rates were going to stay low. So I think there was a lot of stability in the market, even though the rest of the world was kind of on fire. Yeah. And the pandemic hit a huge number of people, especially in the service industry, self-employed, travel, hospitality. Those sectors really, really were hurt. But there was a whole other group of people that were really able to adapt their role and work from home and really had little disruption in their income and in their day-to-day life, except for working from home. And so I think because you still had a great environment for mortgage, you had people who were kind of locked in their home with nothing to do, plenty of time on their hands. So they had time to reinvest in, doing a refinance. They were being really conscious about cash flow. And so folks that may have been a little nervous and wanted to kind of get ready took the time to refinance to lower their rate. Maybe they hadn't done it before. And then you also had people stuck in a house that, that space was no longer going to work for them as they're working from home for an extended period of time. And so they really took the opportunity to change their space, either upgrade or downgrade to a space that made more sense for them. And so I think those were all the kind of factors that, just a great environment for mortgage. And then people with a lot of time on their hands, took opportunity for it. And some people felt like even if they wanted to move, it was a good time to move. They felt like sellers were maybe a little bit more motivated. So it kind of worked out for everybody in the long run.
Yeah, no doubt. So obviously it sounded like a kind of a perfect storm for all of this to happen here. So what did it mean for credit unions though? What's the connection? Because it sounds like, the mortgage and especially the refi, oh my God, you were on the front lines of it, but it sounds like it kept the lights on for quite a few of them that with this new business.
Everybody was really, really busy. It was taking 60 days to do refis, maybe even longer, 90 days, and that was across the board. But for the credit unions, it really meant they were able to serve their members, support their dream of home ownership, the ability to promise of that security, the ability to build, generational wealth and get in the door of home ownership. They allowed them to increase their portfolio at a time when they probably needed it. They needed the increased assets in the organization. Yeah. And I also think it allowed them to really push the limits and understand what they could do in this type of environment when folks are working remote and, really kind of rethinking their business and how to adapt to the change. And so I think it was a great year for financial services, and especially for credit unions, the ability to kind of adapt and rethink. And I really think it's going to help us as we move into into 2021, 2022, to see what norms become the new norms. What are the things that we created during this pandemic that they're not going to let go of, and that's just going to continue to be the norm, and what what we won't return to. And I think it's an opportunity to really assess organizationally what they can do to, cut expenses and not necessarily have some overhead that they had before. So, but it was a great year, and credit unions were a part of it.
Yeah, it sounds like the momentum's going to continue as well. Hey, let's talk rates for a second here. And they dropped, and then they dropped, and they dropped again. They'll probably drop again. Which sent off a flurry of refis, obviously. So where are we in this process of rock bottom rates?
I don't know that they could go any lower, to be honest. I really don't. The MBA has really been focused on the fact that the Fed's been pretty clear in their intentions about keeping short-term rates at zero for the foreseeable future. The Fed's been very clear about federal fund targets, but they've been less clear about the assets that they're going to purchase. It's like MBSs and treasuries. But that being said, there's still been a level of continuity that folks have enjoyed. And it's also really unclear what's going to happen in a Biden-Harris administration as far as regulation and what happens there. But from a rate perspective, I think we're at the bottom. I can't imagine us going any lower. And we're talking about at the end of this year, refinances kind of dwindling off a little bit. They expect rates to rise a little bit, but even if we rise to 3.5, they're still historic lows. 3.5%. I literally, when I started in the business, they were 12, 14, 15% for mortgage. I'm not talking a credit card. I'm talking an actual mortgage. So the fact, they're historic lows. And even though it's just very, very, even a slight increase is still going to be record lows.
Yeah, no doubt. So, I remember us getting excited about having a 7%. It's like, oh my gosh, we got 7%. Are you kidding me? Wow, we were so excited about that. So how can credit unions capitalize on this status with the rates and everything right now? Obviously, they're marketing like crazy to get folks to refi and get into homes and things like that. So how else can they capitalize here?
See, that was my question. Are they, or are they really? Because, historically, and you and I have talked about this before, credit unions are notorious for not promoting mortgages year-round, 365. They get in this rut that it becomes an item that they promote in May and June as the buying season begins. But really, again, and I've said it over and over, mortgage is a 360.5-day sales process. The credit unions have got to continue to push mortgages all the time and remind their staff, educate their staff about what's important. What are the key words? What are the trigger words when you hear this? What are the mortgages that you offer? Do you offer a lot loan or not offer a lot loan? Yeah. And who's the partner? Who's the person in the branch that you send that person to? And I know a lot of the staff in the credit union get very nervous when they talk about mortgage. It's not something they talk about on a regular basis. But if you just arm them with the right, foundation of where to point the person, what are the key words, get them to the right person, that's going to help capture and retain all of that. And it's getting a mortgage is not like getting a credit card. There's planning involved. You need to make sure you have your down payments, that your credit's intact, you've got all of your documentation. So you need to educate the folks, and really home buying seminars, the education, and making sure people are ready to take the application. Those are the things the credit union should be doing now. They should have been doing it a month ago, and they should be doing it next month. Every month building and trying to build that mortgage process and presence, both on the frontline staff and with their back office staff as well. So
yeah, based on your first response and your previous response there, if I was a VP of marketing, I would be just all in on mortgage lending, because again, it's a ripe time for business right now in this area. And
you have to build that. You have to build awareness that you do it. You have to build awareness that you're in the game, because realtors are a strong part of that, and they need to know that you're following up with them and their member on these pre-quals when folks are out looking for property, getting people pre-approved, and just making sure the staff is involved. So it's really, and plus the strength of the mortgage relationship. Once you have that mortgage relationship, so much. The data mining available for information on that member is immense. You gain a lot of information when you do a mortgage application, and you're able, if you have good data mining abilities, you have a wonderful way to stay on top of them. You know what their children, their ages, when things are occurring. You can build out life events. So a mortgage application is really the holy grail of cross-selling products to the member, and really understanding the member so you can serve their needs the best possible way.
Yeah, and it's a 30-year relationship. Come on. So take advantage of that. At least. Can you comment on home valuation? Because I've heard a lot of, rumblings in the industry about, it might be too high right now. It could be dangerous if rates even increase a little bit. What's your take on this right now?
Yeah, and it's true. I mean, and I mentioned that before, just earlier, and I know you and I've talked about it before. Right now, rates have made home lending affordable. Because rates are so low, people can afford a property, and so they may have really been able to purchase a house that at 7% they wouldn't be able to purchase, right? And it would just be way too much. So I think a significant rate hike will hit affordability, but that's not really expected. A minor, half a point increase is really going to do the job. If it goes up a little more than that, we may be having a different conversation because folks are marginally just kind of getting by. But really, again, and you and I, we've talked about this one too, is the other side of the equation. What's really driving the valuation of housing is limited inventory. And it's the fact that we have limited inventory and people aren't moving out, and the dynamics of with the millennials and the Gen Zs and kind of what they're doing. People are either moving up or moving out of their house to create new houses, and we're not building them fast enough. The good news is housing starts continue to be strong in November, which was really good. Single family construction climbed to I think like 2007 levels, 29% higher than we were last year. So over last year, we're up 29%, the MBA said. And the permits for November also increased, which means we're going to see construction into 2021 as well. So that's good news that we're really starting to do a lot more construction and building of new houses. But we've got a lot of inventory shortages across the country. There's some pockets that are okay, but for the most part, nationally, I mean, we definitely are short on properties, which is what's driving the prices up.
Well, and if you're in home construction, that's great for employment as well. Sounds like there's ample opportunity for employment opportunity there, right?
Huge opportunity, and also for construction lending. Both new builds as well as rehabs. So absolutely.
Oh, good stuff. All right, hey, let's hop into 2021. We're barely into it here, but everyone's crystal ball is still a little bit murky here. I've talked to a lot of people say, "Hey, what do you anticipate?" And they're like, "I don't know," based on what happened in the last 12 months. Are you kidding me? So, but can you provide any direction on how the year will go in regards to mortgage lending? It sounds like, just based on what you just said, it's status quo. We have a lot of really good momentum going right now.
Yeah, I mean, we have a lot of good momentum going into the year. What the MBA says, purchases will be about 1.56 trillion, which is over 1.51 trillion in 2005. Refinances, they think, will taper off at the end of the year for a total of 1.2 trillion, which is basically we did 2.1 trillion in refinances in 2020. But still, even with that drop of that much in refis, it's still going to be the second highest year of mortgage production in the last 15 years.
Wow.
So lots of opportunity for purchase business. Rates they expect will go up at the end of mid next year a little bit, and which will help drive off some of the refi business. But it looks really, really good. I think the other things that you see outside of rates is as we get through the pandemic, is you see some stability. You'll definitely see some easing of credit restrictions. A lot of lenders, as the pandemic got bad, raised their FICO requirements, 640, 660. You'll see them to start dropping. We have seen a little bit start to ease back down into 600 or below 600. I think it's still going to be really tough for self-employed borrowers to get approved. And the reason for that is, historically on a self-employed borrower, they would look historically and say, okay, how has this business done in the past? What's the prediction of the future? But with the pandemic, they've really been focused on what's been the impact of the pandemic to the business, and is it sustainable moving forward? Mm-hmm. And so the ability to prove that, to pull in your financials, to make them current, it's a tough walk right now. And so I think even through the pandemic, that's going to continue to be a struggle for some self-employed borrowers. It's not impossible, so I don't want anyone to hear that, but it's a hurdle that they didn't have to cross before. And I think that's going to continue because of the concern of what happens financially even after the pandemic and even after the vaccine is in place. What businesses are still around? What's going to be sustainable? What's not? And I say this every year for the last, I think the last 3 years, you always ask me, and I'm like, this is the year of home equity. Right now, home equity is going to take off this year. We've got all these low rates. People aren't going to want to touch that 30-year mortgage. If they want new cash, they're going to do it through home equity. A broken clock is wrong, 2 times a day, and I've been wrong for the last 2 years. So a broken clock has been outperforming me. But I really think this year you will see some home equity growth a little bit because folks aren't going to want to touch that low interest rate, especially at the second half of the year. And then construction. I think the opportunity in construction lending and rehabs continues to be a great opportunity for us.
Hey, third time's the charm, Steve. Come on. You'll get it right this time. Hey, last question.
Every year. One year I will be right.
I'm sure of it. We'll just keep at it. All right. Last question here for you. So what are some lessons that we learned in 2020 that credit unions can really apply to this year, 2021, and even beyond that, especially in the mortgage lending area?
I think it's, number one was the adaptability. They really were forced to learn how to be adaptable, how to make changes, what's the online experience, how do you build relationships and still stay connected when your branches are closed and not open to the public? And then how does that transition this year and going on to what's the new mechanisms and how does that change marketing plans and all of those type of, like business development and all of those things really are going to change. And it's what we hold on to and what we go back to, right? Trade shows went virtual. How successful was that? And do we go back to virtual trade shows or, and stay in the virtual, or do you want to go back and see people face to face? And then, we didn't do a trade show, but, I think the small regional ones are going to struggle a little bit. I think you'll always have the appetite for the large national ones, but people may have been like, gosh, I didn't spend money. I don't know that I missed it. And so I think it's going to be really difficult for folks to kind of figure out what to do and what to go back for. But I think, the fact that they've really refreshed their online experiences, adaptability or the acceptance of online has really driven behaviors where people may have been a little timid to use mortgage or to how much of the online process they wanted to do. Most people would start with an application online, but then go offline during the processing and then, paper out at closing. But with COVID, you saw people really staying electronic further through the process. And I think you'll continue to see that. People have spent a lot of money on their technology very quickly so they could do that and still do business this year. Right. So I think the rush to technology, the online experience, and just being adaptable, and really kind of figuring out what the new norm is and what we'll hold on to and what we'll let go of.
Yeah, sounds like we're going to be kind of refining that process. So make it better and better for everybody for sure. All righty, sir. Anything else to wrap up? My gosh, we've been through the ringer the last 9 or 10 months.
The only thing we didn't talk about that I think 2021 is going to have is increased government oversight. And part of that is just, what you would expect from a Biden-Harris administration and what their appointees will do. But I also just think we're in this cycle of, coming out of the pandemic, the government's going to, oversight. And that's kind of, and I don't know, and I'm really not sure if it's going to be focused on the servicing side or the production side. Servicing has really been taking it, on the chin prior to the pandemic as far as the oversight. But there's a lot of loss mitigation work going on right now with the pandemic and the forbearance. So they may be getting another round of oversight just to make sure that's done properly. But then there's been a lot of conversation about broker compensation and loan officer compensation as well, that they may get some of the attention. So I don't know what the exam teams are really going to be focused on. We'll see when we see kind of thing, but it should definitely be, people should be expecting more government oversight and kind of focused on the member side and the borrower side.
All righty, sir. Well, good words to live by. Thank you so much for doing this. I know you're a busy guy, so we appreciate the time as always. And this is a great way to kick off Mortgage Monthly. Mortgage Monthly. So
I know about Mortgage Monthly. I'm very, very excited.
Yeah, me too. This will be a lot of fun. So, and for everyone who's out there watching this, the next ones will be live streamed and stuff. So that's gonna be exciting as well. We'll have some interaction as well. So it'll be a lot of fun. These will like refining the online process. They're gonna get better and better.
Exactly. Sounds good.
All right, Steve. Thanks again. Appreciate the time as always. Keep up the good work there. Okay.
Thank you. Have a good day.
You too. Thank you very much for that information, Steve, and stay tuned for next month's Mortgage Monthly here on CU Broadcast.